On average, the first day pop of an IPO is about 10 to 15%. And in 2021, we're expected to have a record number of IPOs hit the stock market. You're probably wondering, why doesn't everyone just invest in IPOs? Well, Timmy, if it were that easy, I probably wouldn't be here making YouTube videos. What's going on, everyone? My name is Ash, bringing you the knowledge, perspective, and resources from my world to help you live a better financial life. Today's segment, I want to talk about IPOs. More specifically, what they are, why they get so much hype, and when an IPO might make sense for you to invest in. To kick things off, IPO stands for Initial Public Offering, and it is the fundamental process that a private company undergoes to have their shares start trading in the stock market, which basically means that a company is going from being privately held to being publicly traded. And now investors like you and I can buy and sell their shares. Why do companies IPO? The key reason why companies IPO is because of more access to capital. In essence, raising more money so they can use that on research and development, marketing, growth, expansion, etc. Of course, when companies start off, they are private companies and very small. So in order for them to grow, they need outside funding. This outside funding comes from venture capitalists. Venture capitalists are the early stage or seed investors that prospect and invest in startup companies. Usually a startup goes through a minimum of 4 rounds of private funding before they go IPO. So in a nutshell, IPO companies are just successful and mature startups that have done really well. So what causes so much hype? Well, usually companies before the IPO are hot trending companies that are seeing rapid success and revenue growth, have unique technology or a cult-like following, or maybe all of the above. So the hype is already there. And when a company decides to go public, they don't just go public. There is a process that they have to go through. First, the company selects an investment bank to work with. That investment bank acts as the broker to price, buy, and sell the shares at a given price to trade in the open market. And the investment bank does this by analyzing the company's financial statements, running valuation models, analyzing competition in the industry, and a lot more other stuff. Then they must file paperwork with the SEC that gives very descriptive information about their financials, their business model, etc. Then the investment bank and the company work together to agree on a share price and a number of shares to issue. And finally, they select a date to offer those shares. In other words, IPO. When talking IPOs, there are 2 important share prices to distinguish. First is the offer price, and second, the trading price. The offer price is a share price that the investment bank decided based on their analysis of the company. The trading price is the price that shares are trading in the open market. In other words, when you and I can buy them. And in many cases, these prices have already seen a significant increase. For example, DoorDash and Airbnb both IPO'd late last year, and both increased over 50% from their offer price. You're probably wondering, how do you get into the offer price? Well, if it were that easy, we'd all be rich. Usually access to IPO shares are exclusive to a select few. First on the list are institutional investors and asset managers, and they are more likely to get in on the IPO because they are buying shares in bulk. Sometimes they agree to buy thousands, if not millions of shares. Next, insiders of that IPO company also have access to shares, like officers, directors, key executives, and employees. And lastly, select brokerage companies. So your brokerage company may get a partial amount. So if you really want to buy shares of an IPO at the offer price, contact your brokerage company for insight and availability. Just be aware that minimum requirements do apply, like years of investment experience and minimum asset balance. So really accessing IPO shares at the offer price is tough unless you're one of these 3 entities, but you can still buy them after the potential pop on IPO day. So what causes that pop? Well, remember that underwriting process where the investment bank calculates the price per share? Well, legend has it that these investment banks price the shares to allow for that, theoretically underpricing them. However, overpricing them can cause the stock to look overvalued by investors and cause the stock to tank on IPO day. And as an investment bank, you want your client's IPO to be successful and pop in the secondary market. But there's a lot of other factors that contribute to IPO pops other than the pricing, like economic conditions, investor sentiment, competition, niche products and services, etc. However, no one can really tell how an IPO stock is going to perform once it starts trading because the market has a mind of its own. And usually long-term success of an IPO company is less dependent on the offer price that was set and determined more by the economic landscape, the future growth of that company, and performance. So how do you know an IPO is right for you? Well, you don't. They're risky as hell, and countless IPO companies have tanked months after going public. But here are 3 steps that you can take to make better informed decisions when it comes to prospecting IPO companies, whether at the offer price or secondary market. Number 1, research the business and industry and ask yourself the following questions. What do their financials look like? Are they profitable, or are they continuously burning cash? What does revenue growth look like compared to their competitors? Who are their competitors? And what makes this company unique? By the way, these are really good questions to ask yourself when you're stock picking in general. Number 2, pay attention as to who are the underwriting banks. Larger, more reputable investment banks tend to have more successful IPOs. So look at an investment bank's track record to see if they have had success on IPOs in the past. This will help with those potential IPO day crashes, and Lord knows it does happen. And number 3, most importantly, be aware of the lockup period. This is key. Majority of a company's IPO shares are held by a number of investors that are not allowed to sell for a given time period. This is what is known as a lockup period, and they can range anywhere between 3 months to 2 years. This is very important because generally when a lockup period ends is when you see a lot of volatility of the stock because of insiders cashing in their shares. This can cause huge dips in the stock price and may, just may, serve as a buying opportunity for those that are looking to get in. So that about wraps it up for IPOs. I hope this gave you a broad overview of what IPOs are and what to look for when you're thinking about investing in one. Just be sure to tread lightly because IPOs are risky business. If this was helpful or interesting, please be sure to hit that like button and also share with those that you think might find this information useful. Also, feel free to chime into the comments on topics that you would like to see in the coming weeks. I'm bringing weekly videos on personal wealth management and market insights, and I would love to hear what topics are top of mind and most important to you. I appreciate you all tapping in. My name is Ash. I'll catch you guys next time.